Question 8. How has the iShares Semiconductor ETF performed in different market conditions? The iShares Semiconductor ETF SOXX tends to exhibit more volatile performance compared to the broader market due to its concentrated sector allocation. Here's a breakdown of how SOXX might perform in different market conditions. Bull markets, market uptrends. Amplified gains. During bull markets, where overall stock prices are rising, SOXX has the potential to deliver amplified gains. The growth potential of the semiconductor industry, a key driver of technological advancements, can lead to significant increases in the stock prices of companies within the NYSE Semiconductor Index, which SOXX tracks. Outperformance. In such scenarios, SOXX might outperform the broader market due to its concentrated exposure to a potentially high-growth sector. Bear markets, market downturns. Exaggerated losses. Conversely, during bear markets where stock prices are generally declining, SOXX could experience steeper losses compared to the broader market. The semiconductor industry is cyclical, and downturns can impact these companies more severely. Underperformance. In a bear market, SOXX might underperform the broader market due to its lack of diversification and vulnerability to sector-specific declines. Increased volatility. Sharp swings. Because SOXX is concentrated in a single sector, its price tends to be more volatile than the broader market. This means its price can experience sharper swings, both upwards and downwards, compared to a more diversified holding. Impact of specific events. Semiconductor industry news. SOXX's performance can be particularly sensitive to news and events specifically affecting the semiconductor industry. For example, a breakthrough in chip manufacturing technology could lead to a surge in SOXX's price, while a shortage of critical materials could trigger a decline. Here are some additional factors to consider. Interest rates. Rising interest rates can dampen economic activity and potentially slow down demand for electronic devices, impacting the semiconductor industry and SOXX's performance. Global economy. The health of the global economy can influence the demand for semiconductors. A strong global economy might benefit SOXX, while a weak one could lead to a decline. Question 9. What are the key risks associated with the iShares Semiconductor ETF's investment strategy? The iShares Semiconductor ETF SOXX offers exposure to the U.S. semiconductor industry, but its investment strategy comes with several key risks to consider. Sector concentration risk. Overdependence on a single industry. SOXX's primary focus is the semiconductor industry. This means its performance is heavily tied to the fortunes of that sector. If the semiconductor industry experiences a downturn due to technological obsolescence, economic slowdowns, or other factors, SOXX would likely see a decline as well. Lack of diversification. Unlike broader market ETFs, SOXX doesn't offer diversification across different sectors. This reduces the ability to hedge against underperformance in the semiconductor industry by potentially strong performances in other sectors. Market volatility. Amplified swings. Due to its sector concentration, SOXX's price tends to be more volatile than the broader market. This means its price can experience sharper increases and decreases compared to a more diversified holding. Investors should be comfortable with this level of volatility. Economic sensitivity. The semiconductor industry is sensitive to economic cycles. During recessions or economic downturns, demand for electronic devices and semiconductors often declines, potentially leading to a drop in SOXX's price. Geopolitical risks. Supply chain disruptions. The semiconductor industry is geographically concentrated, with a significant portion of manufacturing in certain regions. Geopolitical tensions or trade wars can disrupt supply chains and impact the availability of critical materials, affecting SOXX's holdings. Government regulations. Governments can implement regulations affecting the semiconductor industry, such as export controls or environmental restrictions. These regulations could impact the profitability of companies within SOXX. Other potential risks. Currency fluctuations. Since SOXX focuses on US-listed companies, its performance wouldn't benefit from currency diversification. A strong US dollar could dampen the returns for international investors holding SOXX. Technological advancements. Rapid technological advancements can lead to the obsolescence of existing semiconductors. Companies within SOXX need to adapt and innovate to stay competitive, or they risk a decline in their stock prices. Question 10. Does iShares Semiconductor ETF contribute to portfolio diversification? The iShares Semiconductor ETF SOXX offers some diversification benefits, but to a limited extent. Here's a breakdown of how SOXX can contribute to diversification and its limitations. Limited diversification. Concentration on a single sector. The primary focus of SOXX is the US semiconductor industry. This means it doesn't provide diversification across different sectors like financials, healthcare, or consumer staples. Your portfolio's overall performance would be heavily tied to the performance of the semiconductor industry. Benefits within the sector. Exposure to multiple semiconductor companies. While SOXX doesn't diversify across sectors, it does offer diversification within the semiconductor industry. By holding a basket of companies of various sizes, SOXX reduces your reliance on the success of any single semiconductor company. Improved risk-return profile, potentially. Potential for higher returns. The semiconductor industry has historically offered significant growth potential. Including SOXX in a portfolio could offer the chance for higher returns compared to a purely domestic stock holding. However, the risk remains high. Volatility and sector downturns. The potential for higher returns comes with increased volatility. If the semiconductor industry experiences a downturn, SOXX could suffer significant losses, potentially outweighing any diversification benefit within the sector. Alternatives for broader diversification. If you're seeking a more diversified holding for your portfolio, here are some options. Broad market ETFs. These ETFs track major stock market indexes like the SP 500 and offer exposure to a wide range of companies across various sectors. Multi-sector ETFs. These ETFs invest in multiple sectors, providing diversification beyond a single industry like semiconductors. Question 11. Are there other ETFs with similar objectives of iShares Semiconductor ETF, but lower expense ratios? Yes, there are several ETFs with similar objectives to the iShares Semiconductor ETF, SOXX, but potentially lower expense ratios. Here's a breakdown of some alternatives. ETFs targeting the semiconductor industry. VanEck Semiconductor ETF, SMH. This ETF tracks the MVIS US-listed semiconductor index and offers exposure to a basket of US-listed companies in the semiconductor industry. It's a direct competitor to SOXX, with a slightly lower expense ratio, around 0.35% compared to SOXX's 0.46% as of March 10, 2024. Invesco PHLX Semiconductor ETF, SOXQ. This ETF tracks the PHLX Semiconductor Sector Index and provides exposure to US-listed companies in the semiconductor industry. Similar to SOXX and SMH, it offers sector concentration, but its expense ratio might be slightly lower, around 0.60% as of March 10, 2024. SPDR SP Semiconductor ETF, XSD. This ETF tracks the SP Semiconductor Select Industry Index and offers exposure to US-listed companies in the semiconductor industry. It uses a modified equal-weighted index methodology, which assigns a closer weight to smaller and mid-cap companies compared to large-cap ones within the sector. This can potentially offer some diversification within the semiconductor industry, but still comes with sector concentration risk. The expense ratio of XSD is around 0.35% as of March 10, 2024. Important considerations. Expense ratio comparison. While these alternative ETFs offer potentially lower expense ratios compared to SOXX, the difference might be minimal. A lower expense ratio translates to a slightly higher return on your investment over time. Index methodology. Each ETF tracks a different index, which can lead to variations in holdings and performance. Research the specific index methodology of each alternative to understand how it might differ from SOXX. Liquidity and trading volume. Some of these alternatives might have lower trading volume compared to SOXX. This could impact your ability to easily buy and sell shares at the desired price. Beyond sector-specific ETFs. If you're interested in broader technology exposure with lower expense ratios, consider technology sector ETFs. These ETFs might hold a wider range of technology companies beyond just semiconductors, offering some diversification. However, they would still be concentrated within the technology sector. Broad market ETFs. These ETFs, like those tracking the S&P 500 or the entire U.S. stock market, offer the most diversification but wouldn't provide the targeted exposure to the semiconductor industry like SOXX or its alternatives. Question 12. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, a combination of individual stocks or other ETFs could potentially achieve a similar outcome to the iShares Semiconductor ETF SOXX, with potentially lower costs or greater control. Here's a breakdown of the pros and cons of each approach. SOXX versus individual stocks and ETFs. Convenience and diversification. SOXX offers convenience by providing exposure to a basket of semiconductor companies in a single holding. This reduces the time and effort required for research and selection compared to picking individual stocks. Potentially lower costs. While SOXX has its own expense ratio, building your own basket of semiconductor stocks might lead to lower overall costs if you choose commission-free brokers and strategically select companies with lower individual stock trading costs. However, researching and managing individual stocks requires significant time and effort. Greater control. By selecting individual stocks, you have more control over the specific companies you invest in within the semiconductor industry. This allows you to tailor your exposure based on your investment thesis and risk tolerance. SOXX, on the other hand, tracks a predefined index, limiting your control over the holdings. Potential for lower diversification. Building a basket of your own semiconductor stocks might not achieve the same level of diversification as SOXX, which holds a larger number of companies. This can increase your portfolio's risk if a few of your chosen companies underperform. Alternative ETFs. Similar exposure, lower costs. As discussed earlier, there are ETFs like VanEck Semiconductor ETF, SMH, with expense ratios potentially lower than SOXX. These offer similar exposure to the semiconductor industry, but with potentially lower fees. Broader technology exposure. Technology sector ETFs could provide a broader investment within the technology space, including companies beyond just semiconductors. This offers diversification but reduces your targeted exposure to the semiconductor industry. Broad market ETFs. These offer the most diversification but wouldn't provide the concentrated exposure to semiconductors you might be seeking. The right choice depends on investment goals. Are you seeking targeted exposure to semiconductors or a broader technology play? Risk tolerance. Are you comfortable with the potentially higher volatility of individual stocks or a less diversified portfolio? Time and resources. Do you have the time and resources to research and manage individual stocks, or do you prefer a more convenient option like SOXX or other ETFs? Here are some additional factors to consider. Trading fees. If you choose individual stocks, commission fees associated with buying and selling can add up. Consider commission-free brokers to minimize these costs. Rebalancing needs. Both a basket of individual stocks and some ETFs might require periodic rebalancing to maintain your desired allocation. This can involve additional research and trading activity. Alright, Chat ETF fam, let's wrap things up. So, should you buy SOXX? Well, it depends on your investment goals and risk tolerance. SOXX offers a convenient way to gain exposure to the semiconductor industry, a major driver of technological advancements. However, its focus on a single sector means your portfolio rides the waves of that industry's performance. If you're comfortable with some volatility and want targeted exposure to semiconductors, SOXX could be a good option. But remember, there are alternatives. We explored lower-cost ETFs, like SMH, and the option of building your own basket of tech stocks for more control. No matter which path you choose, do your research and understand the risks involved. Don't forget to consider factors like your overall portfolio diversification and investment timeline. Hey, if you enjoyed this SOXX breakdown, be sure to hit that like button and subscribe for more in-depth ETF analyses. We'll be dissecting all sorts of exciting investment vehicles to help you navigate the world of ETFs with confidence. Thanks for joining us, Chat ETF fam, and happy investing.